stop what you're doing right now. Because what just happened in Shanghai in the last 72 hours is not a policy change. It's not a regulation. It's a confession. For the first time in modern history, the Chinese government has officially told its own citizens, you cannot withdraw your silver, not delayed delivery, not reduced allocation, zero. While you were watching the news, while Wall Street was celebrating another stable comics session, the second largest economy on earth just admitted there is no physical silver left to give. And if you think this stays in Shanghai, you haven't been paying attention. Welcome to Currency Archive. I'm not here to waste your time with theories. I deal in what's actually happening in the markets while the cameras are pointed elsewhere. Now, if you've built something in your life, if you've spent decades understanding how money really works, then you know the value of signal over noise. Hit that subscribe button below, not because I'm asking you to, but because you're smart enough to know. When the doors start closing in Shanghai, you want to be ahead of the crowd, not behind it. And drop a comment below. Tell me where you're watching from, because I want to know how far this information is traveling before they try to bury it. On February 9th, 2026, the Shanghai Gold Exchange issued a directive that most people scrolled past without a second thought. The language was bureaucratic. The announcement was technical. And for anyone not deeply embedded in the precious metals market, it seemed like just another regulatory adjustment in a system filled with regulatory adjustments. But for those who understand how commodity markets actually function, the announcement was not administrative. It was a confession. The directive stated clearly that physical silver withdrawals from approved Shanghai vaults would be suspended indefinitely, not delayed, not reduced. Suspended. The term used in the official documentation was zero delivery authorization for retail and commercial accounts pending supply chain recalibration. That phrase, supply chain recalibration, is where the story actually begins. Because in the language of institutional finance, recalibration does not mean temporary shortage. It does not mean logistical delay. It means the system encountered a problem it cannot solve with existing mechanisms. And when the Shanghai Gold Exchange, which facilitates the majority of physical precious metals trading in Asia, tells its participants they cannot withdraw metal they legally own, that problem is not small. The announcement arrived on a Monday morning, Shanghai time. By Tuesday afternoon, the price differential between COMEX silver futures in New York and physical silver prices in Asian spot markets had widened to levels not seen since the March 2020 liquidity crisis. COMEX contracts were trading at approximately $73 per ounce. Physical silver in Dubai, $112 per ounce. In Hong Kong, $118. In Singapore, $123. This is not normal market behavior. In a functioning commodity market, price differentials between regions exist because of transportation costs, import duties, and currency exchange inefficiencies. Those differentials typically range between 2 and 5%. What appeared in the wake of the Shanghai announcement was not a differential. It was a fracture. The paper price and the physical price were operating in completely separate realities. And here is what makes this particularly significant. China is not a minor player in the global silver market. Chinese refineries process approximately 70% of the world's refined silver supply. The country sits at the center of the supply chain that connects raw ore from mines in Peru, Mexico, and Australia to the manufacturing facilities that produce solar panels, electronics, medical equipment, and batteries. When China implements a policy that restricts physical delivery of silver, it is not making a regional adjustment. It is making a statement about global availability. The Shanghai Gold Exchange operates differently than Western commodity exchanges. In New York or London, a significant portion of trading volume involves contracts that are never intended for physical delivery. They are financial instruments, hedges, speculative positions. But in Shanghai, the system was designed specifically to facilitate physical metal transactions. Buyers expect delivery. Sellers expect to deliver. The entire infrastructure exists to move actual metal from vaults to end users. So when that system announces zero delivery, it is not saying the paperwork is delayed. It is saying the metal is not there. The business community should understand what this represents. For decades, the assumption underlying commodity markets has been that physical supply and paper contracts maintain a relationship. That relationship has been tested before. It has been strained before, but it has never been severed at the institutional level by a major exchange in a major economy during a period of rising industrial demand. The timing of this policy is not coincidental. Global solar panel production is accelerating. Electric vehicle manufacturing requires silver for battery management systems and charging infrastructure. Medical imaging technology relies on silver compounds. The industrial demand trajectory for silver has been climbing steadily since 2023, and every major forecasting model projected that demand would exceed new mine supply by 2026. Those projections assumed that above-ground stockpiles, recycled material, and strategic reserves would fill the gap. The Shanghai announcement suggests that assumption was incorrect. Because if the second largest economy on Earth, the economy that controls the majority of global refining capacity, cannot deliver physical silver to its own domestic participants, then the gap between demand and available supply is not theoretical. It is actual, it is measurable, and it is severe enough that a government which rarely admits supply vulnerabilities has chosen to admit one publicly. This is not about conspiracy. This is not about manipulation theories or accusations of market rigging. This is about observable institutional behavior. When a major commodity exchange suspends physical delivery, it is responding to a reality it can no longer manage through normal operations. The question is not whether this policy exists. The question is, what happens next when the rest of the world realizes the physical silver market is no longer functioning the way the pricing mechanisms suggest it is? The Shanghai announcement did not arrive in a vacuum. What appeared to the general public as a sudden policy shift on February 9th was, to anyone tracking institutional behavior over the previous 4 months, the final confirmation of a pattern that had been building in silence. The professionals had already moved. October 17th, 2025. The Chinese Ministry of Commerce published a seemingly routine update to its export control catalog, buried in Section 4.7. 2 was a new classification for refined silver products. The language specified that all silver exports exceeding 500 kilograms would require special licensing approval with a processing window of 45 to 60 days. For context, industrial purchasers typically operate on 7 to 14-day delivery schedules. A 60-day approval window does not slow down trade, it stops it. The announcement received minimal coverage in Western financial media. A few trade publications mentioned it. Most analysts dismissed it as bureaucratic expansion. But the people who actually move physical metal understood immediately what had changed. China had just placed a chokehold on 70% of global refined silver supply. 3 weeks later, November 8th, the CME Group, which operates the COMEX Futures Exchange in New York, implemented a margin requirement increase on silver contracts. The previous margin for a 5,000-ounce silver contract had been $6,200. The new requirement, $9,400, a 51% increase with 5 days' notice. Margin increases are tools used by exchanges to reduce volatility and manage risk. They force speculators to put up more capital, which typically reduces the number of contracts being traded. In theory, this stabilizes price swings. In practice, sudden margin increases during periods of rising prices serve a different function. They stop momentum, they break technical patterns, and they send a message to the market that the exchange is concerned about something beyond normal volatility. The COMEX margin increase happened while silver was trading at $68 per ounce. Within 2 weeks, the price had dropped to $59. The financial media called it profit-taking. The technical analysts called it a correction. But the physical dealers were watching something else entirely. Because while COMEX prices were falling, premiums on physical silver in Asian markets were climbing. By mid-December 2025, dealers in Dubai were quoting premiums of $18 to $22 over spot price for immediate delivery. In Singapore, $24 to $28. These were not normal premiums. Normal premiums in functioning markets range between $2 and $4 per ounce. When premiums exceed $20, it means one thing. There is not enough physical metal available to meet demand at the paper price. And then the arbitrage mechanism broke. For decades, the global silver market operated on a principle called arbitrage. If silver was cheaper in New York than in Shanghai, traders would buy contracts in New York, take physical delivery, ship the metal to Shanghai, and sell it for a profit. This process kept prices aligned across regions. Transportation costs, insurance, and time created small differentials, but the basic relationship held. Arbitrage kept the system honest. In January 2026, that mechanism stopped working. Traders who attempted to buy COMEX contracts and request physical delivery encountered delays, not outright refusals, just delays, vault scheduling issues, transportation complications, administrative processing times. Each delay was explained individually as a minor logistical problem, but collectively they created a pattern. Physical metal was not moving from COMEX vaults at the rate contracts suggested it should be moving. On January 14th, the COMEX registered silver inventory, which represents metal available for immediate delivery, stood at 42 million ounces. By February 1st, it had declined to 28 million ounces. By February 8th, the day before the Shanghai announcement, it had dropped to 19 million ounces. Someone was removing metal from the system, not through normal commercial transactions, not through published reports of industrial consumption. The metal was simply disappearing from registered inventory into eligible inventory, which means it was being reclassified as unavailable for delivery, even though it remained physically in the vaults. This is the institutional behavior that matters. Because while public prices were suggesting silver was available at $70 to $75 per ounce, the people with direct vault access, the people who could actually move metal, were behaving as though supply was scarce. They were pulling metal out of delivery channels. They were paying premiums that made no sense if the paper price was accurate. And they were doing it quietly, without press releases, without explanations, and without concern for what the COMEX price indicated. The Shanghai policy did not create the supply crisis. The supply crisis created the Shanghai policy. And now, with China officially confirming it cannot deliver physical silver to domestic buyers, every industrial purchaser, every manufacturer, and every strategic planner who had been assuming the paper markets reflected actual availability is being forced to reconsider that assumption. The metal left the market first. The price discovery mechanism failed second. The official acknowledgement came third. And the professionals who understood that sequence have already positioned themselves for what comes next. There is a specific type of silence that precedes market dislocations. It is not the silence of inactivity. It is the silence of coordinated repositioning happening below the surface of public markets, executed by entities that do not announce their intentions, do not seek media attention, and do not operate on the same timelines as retail participants. This silence appeared in the silver market beginning in August 2025, 6 months before the Shanghai announcement. The first signal came from an unexpected source, corporate annual reports. Several major solar panel manufacturers based in Europe and North America filed routine quarterly disclosures with securities regulators between August and October 2025. Buried in the footnotes of these reports, under the sections labeled Raw Materials and Supply Chain Management, were mentions of new long-term supply agreements for silver. These were not typical procurement contracts. They were 18 to 24-month forward contracts, locking in specific tonnage at fixed prices with penalty clauses for non-delivery that exceeded standard industry terms. For context, solar manufacturers typically operate on 90 to 120-day procurement cycles. Raw materials are purchased quarterly based on production schedules. Locking in 2 years of silver supply in advance is not normal operational behavior. It is hedging behavior. It is the behavior of a company that has received intelligence suggesting future availability will become a problem. And these companies were not alone. In September 2025, Fresnillo plc, one of the world's largest primary silver mining companies, announced the termination of forward sales contracts representing approximately 12 million ounces of future production. Forward sales contracts allow mining companies to lock in prices for metal they have not yet extracted. It provides revenue certainty and helps manage financing costs. Canceling these contracts means the company believes future spot prices will be significantly higher than the contracted price, making it financially advantageous to accept the cancellation penalties and sell on the open market instead. Fresnillo's announcement mentioned evolving market conditions and strategic positioning. No further elaboration was provided, but the financial implication was clear. A major producer was choosing to forgo guaranteed revenue because they expected the actual market price to exceed their contracted obligations by a margin large enough to justify the penalties. That same month, the Perth Mint in Australia, a government-owned precious metals refinery and dealer, quietly adjusted its delivery timelines for silver products. Previously, the Mint offered delivery within 10 to 15 business days for standard products. The new timeline, 8 to 12 weeks. Again, the public explanation cited supply chain optimization. But the people who operate in this market understood what 8 to 12 weeks actually means. It means the Mint does not have enough physical inventory on hand to meet current order volume without securing additional supply from upstream sources. Then the central banks began moving. Between September and December 2025, central bank purchases of silver, as reported through the World Silver Survey data and Bank for International Settlements disclosures, increased by 43% compared to the same period in 2024. This was not broadly reported in financial media because central bank silver purchases are not headline news the way gold purchases are. But the pattern was unmistakable. Monetary authorities do not increase commodity purchases by 43% in a single quarter without reason. These are institutions that plan in decades, not quarters. When they accelerate acquisition timelines, it reflects a strategic assessment that availability will deteriorate or that pricing mechanisms will become unreliable. The Poland National Bank disclosed in October 2025 that it had added 800,000 ounces of silver to its reserves. The Reserve Bank of India disclosed a similar addition of approximately 1.2 million ounces in November. These were not speculative purchases. These were strategic allocations by sovereign institutions that had concluded physical silver represented a necessary reserve asset in a changing commodity landscape. And then there were the warehouse receipts. In December 2025, an unusual pattern emerged in the London bullion market. Warehouse receipts for silver, which represent ownership of physical metal stored in LBMA-approved vaults, began transferring from COMEX-affiliated storage to London-based vaults at an accelerated rate. Over a 6-week period, approximately 14 million ounces moved from New York jurisdictional control to London jurisdictional control. This matters because warehouse receipts are not just paperwork. They represent actual metal. And when large volumes of metal shift from one jurisdiction to another without corresponding changes in public inventory reporting, it suggests entities with vault access are repositioning assets in anticipation of regulatory or logistical complications in one region versus another. The institutions were not waiting for the Shanghai announcement. They were not waiting for COMEX inventory to deplete to critical levels. They were not waiting for premiums to spike or arbitrage to fail. They were acting on information that does not appear in press releases or analyst reports. They were acting on the kind of intelligence that comes from direct relationships with refineries, miners, and sovereign commodity managers. They were acting on the understanding that physical silver availability was going to become constrained, and that the entities who secured supply early would have a structural advantage over those who waited for public confirmation. By the time the Shanghai Gold Exchange issued its zero delivery directive on February 9th, the professionals had already repositioned. The solar manufacturers had locked in multi-year contracts. The mining companies had canceled forward sales. The central banks had increased reserve allocations. The warehouse operators had moved metal across jurisdictions. The policy announcement was not a warning to these players. It was confirmation that their early positioning had been correct. And now, as the business community begins to understand what zero delivery actually means, the question is no longer whether the professionals knew something in advance. The question is how much time remains before the secondary effects cascade through industries that assumed silver would always be available at something close to the paper price. When a major commodity exchange suspends physical delivery, it does not merely create a localized disruption. It forces every participant in the global supply chain to recalculate assumptions that were previously considered fixed. The Shanghai Directive is not the end of a sequence, it is the beginning of one. And the logical progression of what follows has implications that extend far beyond precious metals markets into manufacturing timelines, energy transition strategies, and inflation expectations across multiple economic sectors. The first pressure point is price discovery. For decades, the global silver market operated under a framework where futures exchanges in New York and London established benchmark prices that physical markets referenced. Industrial buyers used COMEX quotes to negotiate purchase contracts. Miners used futures prices to model production economics. Financial institutions used exchange-traded derivatives to hedge commodity exposure. The system functioned because participants believed paper contracts maintained a credible relationship with physical availability. The Shanghai announcement severed that relationship. If the second largest economy on Earth cannot honor physical delivery at exchange-quoted prices, then those prices are no longer reflecting actual market conditions. They are reflecting contract positions, speculative flows, and derivative hedging activity, but not the reality of obtaining actual metal. This creates a fundamental problem for price discovery. Because if paper markets quote $75 per ounce while physical transactions in Asia require $120 per ounce, which price is correct? And more importantly, which price should an industrial buyer use when planning 12 months of production costs? The answer depends on whether that buyer needs paper contracts or actual metal. And for manufacturers producing solar panels, electric vehicles, medical devices, and consumer electronics, the answer is actual metal. This distinction matters because global solar panel production capacity is projected to increase by 18% in 2026 compared to 2025 levels. Each gigawatt of solar capacity requires approximately 25,000 ounces of silver. The industry forecast suggests demand for solar-related silver will exceed 130 million ounces in 2026. That demand exists regardless of whether COMEX prices reflect it. Manufacturers must secure physical supply or production lines stop. If Chinese refineries, which control 70% of global processing capacity, are restricting domestic delivery, those manufacturers face a decision. They can wait for the policy to reverse, hoping supply normalizes, or they can secure alternative sources immediately, accepting whatever premium is required to guarantee delivery. History suggests they will choose the latter. And when industrial buyers shift from price-sensitive purchasing to panic procurement, premiums do not stabilize, they accelerate. Because the entities selling physical silver and size are not operating on thin margins, they are operating in an environment where available supply has become the constraint, not price. A manufacturer who cannot obtain silver cannot fulfill contracts. A missed production deadline costs more than a higher input price. The economic incentive structure favors securing supply at any cost over waiting for prices to decline. This is where the cascade begins. If solar manufacturers in Europe and North America begin competing for non-Chinese silver supply, they will be bidding against electronics manufacturers who need silver for semiconductors and circuit boards. They will be bidding against medical equipment producers who need silver compounds for imaging technology. They will be bidding against battery manufacturers who need silver for energy storage systems. And they will be bidding against each other because in a supply-constrained environment, the company that secures metal first has a competitive advantage over the company that waits. The London Bullion Market Association, which oversees the largest physical precious metals clearing system outside of Asia, operates on a principle called unallocated accounts. Participants hold claims on silver without designated specific bars. The system works efficiently when supply is abundant because clearing members can net transactions without moving physical metal. But when participants begin demanding allocated metal, requesting specific bars and vault locations, the system becomes strained. If enough industrial users simultaneously shift from unallocated to allocated positions, the LBMA faces the same problem Shanghai is facing. The claims exceed the metal available for immediate delivery. There is precedent for this. In March 2022, the London Metal Exchange suspended trading in nickel contracts after prices spiked 400% in 2 days due to a supply squeeze. The exchange ultimately canceled trades, imposed price limits, and restructured contracts to prevent a clearing member default. The situation was resolved, but it required extraordinary intervention and left participants questioning the reliability of derivative markets during physical supply disruptions. Silver is not nickel. The market structure is different. The industrial applications are broader. But the underlying dynamic is identical. When paper contracts cannot be settled with physical delivery at quoted prices, the exchange must either allow prices to rise until supply and demand equilibrate, or it must intervene to protect the integrity of the clearing system. Neither option is favorable for businesses planning production costs 6 to 12 months in advance. And then there is the inflation implication. Silver is not a headline commodity like oil or natural gas. It does not drive consumer price indices directly, but it is embedded in products that are central to inflation expectations. Solar panels affect energy costs. Electronics affect technology prices. Medical equipment affects healthcare costs. If silver input costs double, those increases propagate through supply chains into final goods prices. And unlike temporary supply shocks that resolve within quarters, a structural supply deficit driven by industrial demand exceeding mine production creates persistent cost pressure. Central banks monitoring inflation trends are already operating in an environment where commodity prices remain elevated despite demand destruction efforts. If silver becomes another input cost climbing beyond forecast models, it complicates monetary policy decisions that are already balancing growth concerns against price stability mandates. The Shanghai announcement did not create these pressures. It made them undeniable. Because as long as exchanges were delivering physical metal, even with delays, the system maintained plausible functionality. Participants could assume that price differentials were temporary, that arbitrage would eventually correct imbalances, and that supply would normalize as inventories adjusted. Zero delivery removes that assumption. It confirms that the physical market and the paper market are operating in separate realities, and that the entities with direct access to metal have already secured what they need, while the rest of the market continues operating under outdated pricing frameworks. The professionals positioned months ago. The manufacturers are positioning now. And the businesses that wait for confirmation, that wait for mainstream financial media to declare a crisis, that wait for COMEX prices to reflect physical scarcity, will find themselves competing for supply in a market where availability has become more valuable than price. The cascade is not theoretical. It is sequential, logical, and already in motion. The only variable is how quickly decision makers recognize that the rules governing commodity markets have changed and how aggressively they adjust their strategies before the secondary effects arrive at their own supply chains.